Welcome to The Explainer. Today, we're digging into the explosive story behind a single stock's incredible surge. We're looking at a company called Everbright Digital Holding, or EDHL, to understand what really happens when a stock price just goes parabolic, seemingly out of nowhere. Here it is. This is the number that gets everyone's attention. A 114% gain in a single day. Now, a move this massive is never random. It's a signal. And our job today is to decode exactly what that signal is telling us.
To really get what that 114% means, you gotta see where this stock came from. I mean, look at this timeline. For months, it was a super quiet stock, trading below 50 cents. Then on September 10th, you see the first little spark of life, a big spike in trading volume. But that was nothing compared to October 14th. That was the real explosion, an absolute vertical launch to a peak of $1.21.
Okay, so let's get into it. We're going to treat this like a crime scene, looking for all the forensic evidence hidden inside the charts and the data. So where do you even start with something like this? Well, the first place any analyst looks is always price and volume. They're the most basic clues, the fingerprints of the market. And in this case, they paint a crystal clear picture of a full-blown speculative frenzy. I mean, just look at the sheer scale of this. The stock went from trading less than 1 million shares a day to a peak of nearly 87 million. That's almost 100 times the normal activity. This is our first huge clue. A massive crowd suddenly stampeded through the door all at once. And here's the catch, right? It's a total double-edged sword. All that volume, sure, it confirms massive interest, but it could also be a huge warning sign. It suggests that pretty much everyone who was ever going to buy, well, they just did. The fuel tank could be running on empty. And boom, here's the proof. On its biggest day ever, after hitting that peak, the stock just collapsed, closing 40% below its high. That is a giant red flag. It's like a massive party where the early guests are already sprinting for the exits while new people are still lining up at the front door. All right, so we've got our first batch of clues. Now let's go deeper. We're going to move past the obvious stuff and pull out the advanced forensic tools, the technical indicators. This is really the million-dollar question, isn't it? Are we watching a rocket that's about to find a new orbit or one that's about to flame out and come crashing back to Earth? These technical signals, they kind of let us peek inside the engine room. Just look at this gap. The price is way up here at $1.07, but its recent average, its home base, you could say, is way down at around 69 cents. Analysts call this an overextended condition. And honestly, it's the perfect description. It's like a rubber band that's been stretched to its absolute limit, and you know what happens next. And this is so key. Overextended doesn't actually mean strong. It means vulnerable. The further and faster a stock runs without taking a breather, the higher the risk that it could suddenly and sharply snap back. If you want just one number to show you how overheated this stock is, this is it. The Money Flow Index. Think of it as a hype meter for the stock, and it's at 98.4. Now, for some perspective, this scale is 0 to 100, and anything over 80 is considered a huge warning sign. 98.4 isn't just hot, it's practically molten. And it's not just one indicator. We don't need to get lost in the jargon here. But the important thing is that a whole dashboard of different tools that measure speed, momentum, trend changes, they're all flashing the same bright red warning light. The message is pretty clear. This rally is running on fumes. So let's recap. We've got the price action, the extreme volume, and all the technical warnings. Now it's time for the verdict. Let's put all the clues together and see what the analysis forecast is most likely to happen next. The analysis lays out these key price levels to watch, which are kind of like potential floors and ceilings for the stock. The support levels you see here, those are the floors where buyers might step in and try to stop a fall. The resistance levels, those are the ceilings, where sellers are probably waiting to cash out, which could stop any further rise. So what are the odds? Well, based on all the evidence, the analysis says there's a 60% chance of a correction, and that means a significant price drop. Then there's a 30% chance it just kind of goes sideways for a while, and only a tiny 10% chance that this incredible rally just resumes. And that brings us to the bottom line here. For anyone thinking of buying in right now, the odds are just stacked against you. The potential for more gains is pretty small compared to the much higher risk of a sharp drop. It's a classic case of an unfavorable risk versus reward. Ultimately, this whole investigation into EDHL leaves us with a much bigger question. Was this just a temporary, speculative bubble driven by pure hype, or is it maybe an early signal of a fundamental shift in how we value new digital asset companies? The charts give us clues about what happened, but the why? Well, that's a story that's still being written.